Have you ever dreamed of taking control of your financial future? Of having the power to protect your investments and even profit when markets move in unexpected ways? If so, it's time to discover the fascinating world of derivatives. Now, before you think this is something too technical or only for Wall Street traders, stop right there. Because understanding derivatives isn't just about finance. It's about strategy, control, and freedom. In this video, we'll uncover what derivatives really are, how futures and options work, and most importantly, how you can use them wisely to reach your financial goals. By the end, you'll see that these instruments aren't mysterious monsters, but powerful tools that can help you manage risk, lock in profits, and open new opportunities. What are derivatives? At their core, derivatives are financial contracts whose value is derived from something else. That's why they're called derivatives. That something else could be a stock, a commodity like gold or oil, an interest rate, or even a cryptocurrency. Think of a derivative as a mirror. It reflects the price movements of another asset. You don't need to own the asset itself. You simply make an agreement based on its future price. This is where the magic and the power begins. Stay tuned and make sure to subscribe, because later in this video, I'll reveal 4 powerful ways to use them that you definitely need to know. Let's break down what futures are. A future is a contract to buy or sell an asset at a specific price, on a specific date in the future. Let's imagine you're a coffee producer, and you're worried that coffee prices might drop in 6 months. You could enter a futures contract today to sell coffee at a fixed price, protecting your business from uncertainty. Now flip the situation. You're an investor who believes coffee prices will rise. You could buy a futures contract, and if prices go up, you profit. So, futures are about commitment. They're agreements that must be fulfilled when the contract expires. They're used by both hedgers to manage risk and speculators to make profit from price changes. But remember, leverage cuts both ways. The same mechanism that can double your profits can also double your losses. That's why using futures requires discipline and a clear plan. Now let's talk about options, the most elegant type of derivative. An option gives you the right, but not the obligation, to buy or sell an asset at a set price before a certain date. There are 2 types: call options, which give you the right to buy, and put options, which give you the right to sell. Here's why they're fascinating and practical. Let's say you think a stock will rise, but you don't want to risk too much money. You can buy a call option paying only a small premium. If the stock goes up, you profit. If it doesn't, your loss is limited to that small premium. In other words, options give you control without full commitment. They're like reserving a seat at the table without having to pay for the whole dinner, unless you actually show up. This flexibility is what makes options one of the most powerful tools in modern finance. How to use derivatives wisely. Here's the truth. Derivatives are not a get-rich-quick tool. They are risk management instruments first and profit opportunities second. So how can you use them wisely? 1. Hedge your risks. If you have investments exposed to price changes, use derivatives to stabilize your returns. Example: you own shares of Apple, but you're worried the price might drop in the next few months. You could buy a put option. If the stock falls, the value of your put rises, offsetting your loss. It's like buying insurance for your investment. 2. Enhance your income. Selling covered call options, for example, can generate extra income on stocks you already own. Example: you hold 100 shares of Microsoft. You sell a covered call option at a slightly higher strike price. If the stock stays flat, you keep your shares and the premium from selling the option. If it rises above the strike, you sell your shares at a profit. Either way, you earn money. 3. Speculate smartly. Use small amounts to take strategic positions without risking your entire capital. Example: you believe gold prices will rise soon. Instead of buying physical gold, you buy a futures contract or a call option on gold. Your potential profit is multiplied, but your initial cost is much lower. Just remember, if you're wrong, your losses can come just as fast. 4. Always define your risk. Never enter a trade without knowing how much you can lose. Example: you buy an option worth $200. That $200 is your total risk, nothing more. You can't lose beyond the premium you paid. Setting limits like this helps you stay disciplined, calm, and consistent. The key is to see derivatives as insurance for your portfolio, not as gambling chips. Used correctly, they can smooth out volatility and protect your long-term goals. Derivatives can magnify returns, but they can also magnify mistakes. That's why professional investors use them with rules, discipline, and a clear purpose. The secret isn't in predicting markets, it's in preparing for them. You don't control the wind, but you can set your sails. Let's break down my final thoughts. Derivatives, futures, and options might seem complex at first, but at their heart, they're about choice, control, and strategy. They allow you to plan for uncertainty, to turn fear into foresight. Remember this: knowledge is leverage. And the more you understand these instruments, the more power you have to shape your financial destiny. So take the time to learn, to practice, and to think strategically. Because the future, your future, belongs to those who prepare for it. Do you want to find out how to save more, invest better, and plan concrete goals? If you'd like to know more, subscribe to the channel and watch the next video.